Hey, how you doing? This is Adam Post, publisher of more than 1,000 comic books and marketing expert covering Disney. Disney is in trouble again. Both of the Bobs getting sued. And not just the Bobs, other execs at Disney, as well as the board of directors at Disney. The one good thing is that at least Kareem Daniel is being sued, and I've been thinking he should be sued for a very long time now. He's the guy who used to be in charge of Disney media and entertainment distribution. He's made a lot of money. The board will probably pay for all his legal fees, but at least this guy's getting sued. He made a lot of mistakes. Somebody needed to sue him, and I'm glad to see him sued. Disney executives are getting sued for insider trading and lying to the public in a massive new lawsuit. Let's get into the story. Before we do, please be sure you are subscribed to the channel. Click the bell for notifications. Give me a thumbs up. I really appreciate you guys. I'm trying to get to 30,000 subscribers, so if you can subscribe, please do subscribe. Coming from The Hollywood Reporter, Disney gets sued again. Investors sue Disney over alleged Chapek-era cost-shifting scheme to hide streaming losses. They have been trying to hide, and they've been successful at hiding streaming losses for a long time now. This investor has done a thorough job with a very long lawsuit covering a lot of different issues, and also decided to throw in the fact that, hey, you know what? Maybe a couple of these executives should not have been dumping millions of dollars worth of stock and pocketing the money when they knew that the stock was probably going to go down. I don't know if they knew they were going to go down, but this investor in his lawsuit makes that allegation. The suit takes aim at former CEO Bob Chapek's lofty subscriber growth and profitability targets for Disney+. The entertainment giant faces a host of litigation dealing with efforts to boost subscriptions for its streaming service. What it doesn't take on is what is truly the biggest deal. The biggest deal is this: Disney taking a $2.4 billion charge. Charge means expense, but it's like a one-time expense. It's an expense they don't expect to be repeating on a regular basis, but still, it's a very big expense. That was for their direct-to-consumer content purge. So just like Warner Bros. Discovery got rid of a bunch of series, a couple of movies they decided they didn't want to put out, Disney did the same thing because, of course, if Warner Bros. Discovery does it and it looks like people like it, Disney copies that strategy. Whatever the business strategy is, at the same time, that's another loss. And that's a loss that's being hidden, and it's a much bigger manipulation than what this lawsuit even claims. As Disney stock hovers at its lowest levels in nearly a decade, the company was hit with another lawsuit alleging it misled investors about the success of Disney Plus by concealing the true costs of operating the platform. I mean, when you're going to go ahead and you're going to produce millions and even billions of dollars worth of content, and then you're going to say, oh no, you know what? Sorry, I'm going to charge that off. We don't really need that content. That was, just a mistake. Don't even judge us based on that. Disney's lost $3.7 billion operating Disney Plus, not including this $2.4 billion charge in the last 12 months. I do not know why it's not included in lawsuits. If I was suing Disney, I certainly would be including that charge in the lawsuit and asking for lots of information on how did you go about making these movies, making TV shows like Willow, and then deciding they were completely worthless. And oh, by the way, it's just a one-time expense. Disney is being accused again of lying about the extent of its losses to hit lofty subscriber growth targets and claiming that the streaming service was on track to achieve profitability by the end of 2024. Investors detail a scheme to inappropriately shift costs by debuting content created for Disney Plus on legacy platforms to move marketing and production costs. So if they go ahead and they say, listen, we're going to take this Disney Plus show, but first we're going to show the show on ABC, which is another division that they own, they can attribute some of the costs of production to ABC. Maybe they didn't disclose it clearly enough to make these investors satisfied. They didn't disclose it, but I don't know that they were even really honestly required to disclose it. The trickier stuff is what they're doing internally with all of their cost shifting on production, as well as these one-time charges that are these extraordinary losses they're not taking responsibility for. The complaint filed on August 23rd in California federal court is at least the third taking issue with the company's efforts to boost subscriptions for its streaming platform. It faces an identical investor suit over an alleged cost-shifting scheme in its streaming division and claims that it obstructed a deal between TSG Entertainment Finance and 20th Century Studios, which Disney owns, to prop up Disney Plus and inflate its stock price. The deal with TSG Entertainment Finance was a deal that was established between TSG and Fox before Fox was acquired by Disney. The deal with TSG is absolutely outrageous. When I say outrageous, TSG put up cash to finance production of their movies. They didn't know how the movies were going to turn out. They hoped they would do well. They have revenue sharing based on that. Disney, when they acquired Fox, saw this TSG deal, which conveniently seems to end this year. It was like a 10-year deal for a bunch of films, and Disney has absolutely nailed TSG on things that, in my opinion anyway, are really like absolute theft. I mean, they're horrendous in terms of taking advantage of TSG, hiding revenues, hiding profits, just to the point of absolute ridiculousness. There's Hollywood accounting where you say, well, you know, this costs a lot of money and we have to actually count in this overhead before we share profit with you. But this wasn't like that. I'm telling you, this is the worst of the worst. We'll take a second to talk about TSG. The TSG situation is so bad. TSG had a right to sell its ownership of different deals that it had made for the film. So it owned X% of Avatar. It owned X% of different X-Men movies. Okay, fine. Disney prevented TSG from being able to sell those interests to other outside investors so they could then get new cash back. And then under this deal with Fox, which then was Fox Disney, because Disney acquired Fox, they could reinvest in more of these upcoming projects. Avatar 2 was one of them. So they had an interest in Avatar 2. They still have an interest in Avatar 2, but Disney wouldn't allow it to sell that interest. So they couldn't get cash back out of the deal, which meant that they didn't invest in enough deals under the agreement with Disney. And as a result, Disney gets to claim back half of the profits that TSG made in all of their deals together, because Disney interfered with TSG doing things that are normally done under their agreement. As a result, Disney will be able to say, oh, you know what? Those interests that you own in those individual movies of ours, we're not going to let you sell them. And by the way, because you owe us half the money back that you made from all of these projects, because you didn't invest enough with us, we're going to take those back. So TSG is suing, and I hope they have success, because this is one of the most predatory, destructive things you could possibly do. In addition to that, they also didn't share the benefit of licensing deals for the content. So, for example, HBO Max had an exclusive deal for Avatar 2. Disney said, hey, look, let's do a lesser revenue deal because we want to also show it on Disney+. So Disney did that so it could have Avatar 2 for Disney+. That's understandable. But TSG loses out on the revenue because now it's a non-exclusive deal and they're not doing anything for TSG. They're not paying TSG for any of that. They're just basically taking the ownership of TSG in Avatar 2 and stealing it from them. It's truly incredible, which just goes to show you, you really have to trust the people you're working with and have good contracts. And sometimes you have to sue, especially when ownership changes like it did with Fox and Disney. Apparently, Disney had been messing with them on the revenue and the income for years, but probably Fox was a little bit, but Disney made it ridiculous. The suit claims that company executives hid the expense and difficulty of maintaining subscriber growth as it suffered staggering costs to create content. In an effort to hide losses, former chief executive Bob Chapek, his lieutenant Kareem Daniel, glad to see you being sued, Kareem, and former CFO Christine McCarthy aired The Mysterious Benedict Society and Doogie Kamealoha, MD, which were supposed to be Disney Plus originals on the Disney Channel to make the streaming service appear more successful than it actually was. Okay, but that's, let's say Disney did that, and obviously they did do that. They didn't disclose they were doing that to investors. I don't think they're going to get in much trouble for those two silly little series, because how much could it have changed their production reporting? It's 5 million, 10 million, 100 million. It's not that big of a number where you look at Disney's results and say, oh, they've lost more than $11 billion on their streaming service. So 100 million or 50 million of it should have been added to the total. I don't even know what the rounded up number is from $11 billion. It's more than that. So if you added up 100 million or 50 million from the Doogie Howser female remake, it wouldn't have made any big difference with this cost sharing. And it's not like cost sharing is something you can't do. And it's not like they didn't get value for the Disney Channel service by putting that show on the Disney Channel. I almost feel like that's something that Christine McCarthy put out deliberately so people really wouldn't look at what's been going on with their costs of production and how they're taking a profit when they sell shows to Disney Media Entertainment Distribution, Kareem's old business. So Disney was having separate production companies that it owned produce TV shows and films for its own distribution company at a very high inflated rate and taking profits on that. That's really where the manipulation is in, but I still don't see it in any of the lawsuits. Investors take issue with statements from the executives touting gains. For example, in December 2020, Chapek said, quote, Disney Plus has exceeded our wildest expectations with 86.8 million subscribers as of December 2nd, and that the success of the platform has bolstered our confidence in our continued acceleration towards a direct-to-consumer first business model. He repeatedly stated that it would be profitable by the end of 2024. This forecast represented an astounding threefold increase from prior estimates without any degradation in expected profitability for the segment, the suit says. There are always, though, disclaimers when statements are made that, hey, these are forward-looking statements. You have to be careful about relying on them. I'm not sure it's going to really result in any kind of benefit for the lawsuit. After acknowledging that subscriber growth had slowed in 2021, Disney reported last year that it missed analyst estimates by wide margins on revenue, sales, and earnings. In the fourth quarter of 2022, the company's direct-to-consumer arm, which includes Disney+, ESPN+, Hulu, and Hotstar, reported an operating loss of $1.47 billion, up from $630 million lost in the same quarter the year prior. Disney's stock plummeted by more than 13% at the time. But you know what this loss of $1.47 billion did not include? It did not include a $2.4 billion charge, a quote, one-time charge that Bob Iger took when he had a bad quarter. Bob Iger actually lost more money operating Disney Plus than Bob Chapek did when you include that charge. The accountants who are listening to this know exactly what I'm talking about, and you business experience guys know as well. When you see charge, it means expense. It doesn't mean it's necessarily going to happen every time they report profits, but it isn't something that should be ignored, especially when the charge for $2.4 billion was from expenses from a year or two ago. The company also reported a decline in its average revenue per Disney Plus subscriber as more customers subscribed through a discounted bundle with the company's other services. Notably, the bundled offering made up about 40% of domestic subscribers, confirming that Disney was relying on short-term promotional efforts to boost subscriber growth while impairing the platform's long-term profitability. I don't know about this accusation. You're saying, oh, well, you got Disney Plus signed up through a Hulu bundle or an ESPN Plus bundle, and we don't like that because it's at a lower price because it's part of a bundle. Bundling is definitely part of the content business. You can't really separate that from the content business. There's no excuse for some of the things they did, but there are some excuses for some of these things that they did. The suit also details Disney's pivot to prioritizing streaming amid the pandemic. While the company's theme parks, resorts, and cruise lines were forced to close as movie theaters shuttered, subscriptions to Disney Plus rapidly took off, according to the complaint. When the service launched in November 2019, before Chapek took over, Disney set an initial target of 60 million to 90 million subscribers by the end of 2024. But after Chapek assumed leadership, Disney Plus experienced higher growth than originally anticipated, gaining over 50 million subscribers in its first 5 months and nearly 74 million subscribers in its first year. Against this backdrop, Chapek decided to go all in on the platform, announcing a major reorganization of the company's media and entertainment operations. Distribution and commercialization activities were centralized into the Disney Media and Entertainment Distribution arm, which essentially became responsible for the monetization of all content globally. And that is exactly what happened. All of the production units that would normally go and try to make a deal with Netflix, that would normally go and try to take the film and then market it to movie theaters, all of those individual production divisions were told, no, you now sell your content to Kareem Daniels, the head of Disney Media and Entertainment Distribution. That was a separate company that Disney owned. This is where the transfer price issue came in, where they were producing it at one rate and then selling it to themselves at an inflated profit at another rate. This has created probably 80 to 90% of the production-related problems Disney has. A lot of the problems they have is because their content is content consumers no longer want or even trust. Investors say the reorganization represented a dramatic departure from Disney's historical reporting structure and was hugely controversial within the company because it took power away from creative content-focused executives and centralized it in a new reporting group led by Kareem Daniel. Prior to this, Disney was organized into 4 reporting segments comprised of media networks, parks, studio entertainment, and direct-to-consumer. With this new structure, Chapek removed budgetary and distribution control from the heads of Disney's content groups and placed control in the hands of DMAD's new chairman, defendant Kareem Daniel, who reported directly to his longtime mentor Bob Chapek, states the complaint, which notes that the duo exerted near-complete control over the company's strategic decisions around content. After Bob Iger, who was also named in the complaint, returned to lead the company, he made clear that an important component of restoring Disney's success would be to return power back to creative executives, including distribution decisions. When they say distribution decisions, what they mean is instead of Kareem Daniel being the only person at the company who had the authority to say, okay, this movie that Pixar is making, it's not going on the streaming service. It's going to be released first in theaters, or even at all on the streaming service instead of at all in theaters. Kareem Daniel had the power to do that with all of the content from all of the divisions. I don't know if that was a problem or not. The problem I have with their whole structure was when they had to compensate the production divisions. They allowed the production divisions to charge completely ridiculous high costs to their own distribution company, the one that Kareem Daniels was the head of, DMED, which made almost all of what they were doing not viable. Here's what I mean. When Bob Iger wrote his book, Ride of a Lifetime, he explained that in launching Disney Plus, he told the heads of production units, look, I'm not going to pay you a huge amount of money just to produce for the streaming service. You're going to produce it at whatever it costs, and I'm going to give you, as the head of production, some additional Disney stock based on what my discretion is of how well you did with producing the content. There isn't going to be profit sharing. You're not selling it to some outside company like Netflix. You're not selling it to movie theaters. You're selling it to your own sister company. You're selling it inside of Disney. So as a result, the only way to really compensate you fairly is not to pay you some extraordinarily high market rate for the content, but to give you some stock so that you could be rewarded that way because you're helping to build the company. That wasn't ideal. It was approved by the board, and that's how they did it up until the creation of Bob Chapek's DMED. At DMED, they just paid ridiculous inflated rates for content, such as $25 million for every She-Hulk episode. To give you an idea, at Netflix, when they did 60 shows for Netflix back in 2014, which granted was a while ago, but 60 shows for Netflix back in 2014 was something that they paid $200 million for. So a little bit more than $3 million an episode versus now $25 million an episode. Netflix only pays $25 million an episode for Stranger Things. Stuff like Sandman, $15 million max. Doesn't matter how popular it is. Netflix will not pay $25 million per show for any other show really other than Stranger Things. Everything else comes cheaper because Netflix isn't paying some inflated rate to pay off their production department in some very strange arrangement. Netflix even almost canceled Sandman because they didn't want to pay $15 million an episode. That same show, Disney Plus, would be paying at least $25 million a show for. Something is deeply wrong. These lawsuits will eventually catch up with Disney because Disney is not going to be able to get each of these all dismissed. Maybe they'll make a settlement, but there are a lot of investors and there are a lot of losses. And no one really looks at Disney stock right now and feels like, hey, this thing looks like it's going to shoot through the sky. People have different ideas about why Disney stock is so low, but there are very few people that are saying, hey, we expect this stock to explode. You should buy this stock, except for people that are clearly trying to mislead people. Let me know what you think of all this in the comments below. Always love to see your ideas. Please be sure you are subscribed to the channel. Click the bell for notifications. Give me a thumbs up. And I'll see you again soon with another video. And if I don't see you, I will miss you.